Okie dokie, guys. I think we're ready. I think we are live at the moment. This is my first time doing one of these YouTube lives. So, you guys are going to have to let me know if you can hear me okay, if you can see me okay. I think the microphone's on. I think the webcam should be okay. I'm now going to also share my computer screen because I've got a lot of stuff to show you, basically. And let's see if I can do that now. And also maybe that allows people to start joining the call. Let's have a look. So share screen. Right. I think you should be able to see this. Okay. I'm going to keep kind of going back and forth between the Excel, so not the Excel, the PowerPoint presentation / all my Chrome tabs and this, right? So basically, if you have any questions, put them in the comments. Okay. I don't think there's really many people live at the moment. That's what happens when it's your first YouTube live, but that's okay. I'm sure people will join later on. Or if you're watching this in the future, maybe some days from now, maybe some weeks from now, basically you can just email me any questions and I will get back to you. I'm always open, basically. So let's see. Let's get started, guys. Let's get started. Oh, by the way, there's going to be a Q&A section at the end. I'm not really sure how long this is going to be. I'm going to be at least here for an hour, something like that. So, you can hop on, you can do everything you want. Let me know any questions that are going to take longer at the end, okay, in the Q&A. But if there's any questions that you have as I'm going through something, just let me know, okay? So basically, guys, the whole point of this live stream, of this workshop, is that I basically want to show you how to get a 10% rate of return on your investments that also pays you passive income, right? A lot of passive income that grows over time so that, one day you can use those dividends, that passive income, to fund your expenses. And basically, you might be asking, who am I? What do I know about this? Well, my name is Ricardo Torres. Hopefully you already know me. Hopefully you're subscribed to my YouTube channel or you are in my email list, okay? That's kind of where I've shared this workshop in. So basically, if you don't know who I am yet, basically I'm just a regular guy. I used to be a mechanical engineer and I used to live in England. But I was very happy with my career and I just basically decided to make the switch and do what I was actually passionate about, which is investing in dividend growth stocks. Because, I've been doing this for quite a few years now and I already make enough in dividends, right, to cover a lot of my expenses. I don't cover my rent yet, okay? That's like the next big milestone, but I'm pretty close to being there, all right? So basically, that's what I've been doing for many years now, and now I teach people like you about this, hence why I create weekly videos on my YouTube channel. Not that I've been too good at that. I've not posted anything for about a month and a bit now, but that's the reason why I do what I do, okay? So in this workshop, basically I want to share as much as possible with you guys and with anyone that watches this in the future, and also basically introduce you to what I've been working on for the last 7 months, which is a piece of software that's called Dividend Compass, and it's pretty cool. It makes your life so much easier in terms of dividend growth stocks, okay? So basically, let's move on to step number 1, guys, okay? Let's get straight into this. There's quite a few steps, but I'm going to show you the whole process from start to finish, okay? So let's say you got some money at the end of the month or at the end of you just got paid from your job. You got some money, you want to invest it. You want to invest it well, okay? So your money grows over time, but you also want some passive income. You want those stocks to also pay you money as time goes by so that, one day you don't have to pay for anything because all your investments are paying for everything that you spend, okay? All your expenses, all right? So basically, step number 1 to be able to achieve that is to focus on dividend growth. Now, dividend growth is just when a company increases the dividend that it pays, okay, the amount of money that it gives you as a shareholder. And remember, you only have to hold those stocks in order to in order to deserve that dividend. If you hold shares during the time the company says, right, we're going to pay dividends on this day, you are going to earn those dividends, okay? You don't have to do any work at all right? But it's not just because of the dividends, okay, guys? That's very important. It's not just about the fact that a company pays dividends, okay? Check this graph out on your screen right now. This is a very popular graph that gets used a lot by dividend growth investors, including myself. I love it. Now, what this basically shows you is all the companies in the S&P 500 that basically they've divided them based on their dividend policy. What I mean by that is that basically depending on whether that company pays a dividend or doesn't pay a dividend or grows its dividend, okay, it's split it into different bands, and it's shown you the performance of those types of companies from like 1972 to 2018, okay? That's like 2 years ago. This is pretty much, over the long run, I'm pretty sure this is going to still be the case, okay? There's over 40 years of data on this graph, okay? And what I want you to focus on, guys, is that, so the S&P 500 is in green, okay? So you can see green here. It ended as $2,741, okay? That was, I believe, for every $100 invested, okay? So that's some phenomenal growth already. However, the blue lines are what I want you to focus on, because those are companies, first of all, that pay dividends, okay? You can see here, the dark blue line are companies that out of all the companies in the S&P 500, those companies that pay dividends are, that dark blue line, okay? And it's pretty much double what the S&P 500 actually produced over those 40 years, all right? But the really cool thing here, and why I want you to really focus on companies that grow their dividend, is the blue line, guys, okay? The blue line over here, those are companies that increase their dividend every single year, right? There's a lot of examples of these companies. We're actually going to get into 3 of those. I want to give you 3 companies, 3 dividend growth stocks that I personally love, that I personally own myself as a shareholder, and that are probably going to make you a lot of money over the long run, okay? I'm not a financial advisor, okay? Don't just take any of this as a recommendation, just to go out there and buy them. Take all this stuff, all this knowledge as just that knowledge, okay? So that you can then get that knowledge, go out there and do all this yourself, okay? Armed with all the right knowledge. I'm sounding like Ty Lopez over here, okay? But basically, this is it, guys. Companies that grow their dividends just tend to do better over time, all right? So basically, that's step number 1. If you just do that and you focus on investing in companies that grow the dividends, you're pretty much ahead of a lot of people, okay? You're not going to get insane returns. You're not going to get 20% per year, but that's really hard to do over 40 years of time, if not impossible, okay? So basically, that is step number 1, guys. Focus on dividend growth. Step number 2 of what I personally do is to filter stocks to get that 10% rate of return, right? If you don't know what rate of return is, I think that's actually the title of this workshop. It's basically how much your investments grow per year, right? Now, the really cool thing about 10% is that it's just really good, basically. Now, using a thing called the rule of 72. Basically, just going to pull up my calculator here. If you divide the number 72, you probably won't see this because it's a different app. But if you divide the number 72 by the rate of return, that tells you how many years it's going to take for your money to double, okay? Assuming that you don't invest anything else ever again, all right? Now, at 10% rate of return, your investments, the money that you start with, is going to double every 7.2 years, more or less, right? So every 7 years, that money is going to double. In 14 years, it'll be 4 times the initial amount, okay? That's how powerful this is. And, the overall stock market, the S&P 500, over the long run has actually kind of got to this point. Depending on the sources you find, it'll be slightly lower. But I normally consider the overall economy and stock market in a developed country. I normally take anywhere from 7 to 8% rate of return, right? Which is great. It means that your money doubles every 10 years, more or less, which is phenomenal. Okay, if that's all you take away from this workshop, just do that. Invest in an index fund, and you will do really well already. Okay. But for me personally, that's not enough, okay? It's not that I'm greedy. It's just that it's not actually that difficult to get a 10% rate of return, okay? We're not talking Warren Buffett levels here, okay? A 10% rate of return is actually fairly manageable if you know what you're doing. And that's exactly what I'm going to show you in today's video, okay? So let me just quickly check the chat. By the way, guys, if you have any questions, just let me know in the chat. I'll keep switching between the presentation and the Magdalena Grings, elbow cuff, cool. Okay, I think Francisco's also made a comment. Cool, guys. Thanks for being here with me, guys. I'm going to keep checking. If you have any questions, let me know. There'll also be a Q&A at the end, all right? So basically, guys, filter to get, okay, that's step number 2. Right, filter to get 10% rate of return. How do you do that, okay? Now, here's it's not really the tricky part, but this is kind of the stumbling block on a lot of beginner dividend investors, okay? Where do you find these companies, right? How do you know if a company, can give you a 10% rate of return, or whether a company has been paying a really great dividend for a very long time, right? I mean, you could go to Google, for example, and search for Coca-Cola stock, right? Coca-Cola stock, by the way, actually Coca-Cola, the company, it's a fantastic company. It's dividend growth stock. It's actually a dividend king, meaning that it's been increasing its dividends for more than 50 years straight, okay? No pauses or anything. And now the stock's done pretty well over time. I mean, obviously pretty well. But this is one company. A person can tell you, hey, look at Johnson & Johnson, look at Procter & Gamble, right? The well-known companies that have a track of increasing the dividend. And that's great. That's a great starting point, but it's not enough, okay? Because there's hundreds of companies, guys. I think at the moment there's around 800 companies or more that have been increasing the dividends for at least 5 years. That's a lot of companies, okay? And there's a lot of really good opportunities in those companies. So what I'm going to show you now is what I actually teach in my course, okay? I'm not selling you my course, don't worry, but I have a course called Freedom with Dividends. And basically what you're getting here for free is what I teach my customers, my students, okay? And basically what I tell them to do is go to the dripinvesting.org website, okay? Don't be fooled by the look of this website. It looks kind of old, but over here, basically you get the Dividend Champions Excel spreadsheet, okay? This is a great starting point because so there's a guy, what's his name? I think Justin Long, I believe, or Justin Law. Justin Law, right? Here we go. He's a Seeking Alpha contributor, and he basically curates this list that was actually started by Dave Fish, okay? Very famous dividend investor in the online community. And, they basically created this spreadsheet that basically has a lot of data, right? Look at all this data. Don't be scared by this, all right? There's actually, on the site itself, there's like a filter document, okay? And it does a pretty good job of letting you filter by certain things. But this is pretty much where most dividend growth investors online go to actually get their data, okay? This and perhaps Seeking Alpha and just the company's individual websites. And that's great. That's a great starting point. And in fact, I used to use this myself until about 7 months ago. The problem I had with this data is that it's not exactly that reliable, okay? It's just one guy, but once a month, he just goes there and he manually inputs the data. He manually checks all the dividend yield, the current dividend, the P ratio, the earnings, a ton of different metrics, and he puts them into a document that gets updated once a month, right? The problem with that is that oftentimes you're going to miss on really good opportunities because your data is old, okay? It's a few weeks old, and sometimes things happen quickly, especially with what's happening now in the world. Also, it's the fact that it's just one guy, okay? And, he's doing an amazing job, but personally, you invest in your life savings here, okay? While it's a great starting point, I wanted to basically create a way to find all these companies using an API, right? Using an API that's like data that's provided by you that gets updated at least once a day, okay? If not more often. So that's basically what I did, guys. I created an app called Dividend Compass, right? This is the page. You go to dividendcompass.com. I've just put this live very recently. I've had some beta testers go through it. But basically, and I'm going to show you what it's like in a second, right? But basically what this does is it gets a ton of information that basically lets you filter out companies and really, really quickly analyze them and then track them, okay? Now, this is the first time I'm showing this to the public, okay? So obviously I'm pretty excited. I've kind of locked myself in my room for the last 7 months, and I've basically created this. So let me just show you real quick. This is the screener, okay? This is where you go to filter out stocks and to find opportunities, okay? Let me just take a sip of water. I'm just going to quickly check if there's any comments. So Lahib has asked, will this trick be available when it's, this stream? Yeah, it will be available. So, if you don't have time to finish watching it, I will upload this to my YouTube channel. So don't worry about it. You can consume all this. Also, I'm just realizing, I've got this light here, right? Because it's really dark outside. So I'm just going to put it a bit slightly lower because it's a little bit too bright. And that's a bit better. Anyway, guys, so this is the screener inside Dividend Compass, all right? Now, and this is where it all starts, okay? So you can actually filter out all, like 961 companies at the moment that I get in-depth data for. You can filter out by sectors, okay? Let's say you only want industrial companies and healthcare companies, right? Very, very easily. These colors that you see here, by the way, throughout the app, they are to do with the industry, sorry, the sector that they are in, okay? But let's not worry about sector for now. And let's go into dividend streak. All right, guys, here you go. Here is where you can filter out by dividend streak. So let's say I'm only interested in companies that have at least a 10-year dividend streak, okay? And out of those companies, let's put the highest streak first, okay? Look at that. 65 years, American States Water. That's the company with the longest track record, I believe, in the world in terms of increasing its dividends every single year, guys. Okay, so very, very good company. But basically, this is where you start, guys. This gets information that is up to date and doesn't rely on someone manually inputting the data. So that's basically why I created that. I created Dividend Compass for myself to help me make better investment decisions, and it's got to the point where I'm going to say myself, it's pretty damn good. Okay, I really love it. I already use it exclusively, and if you go there now, you can already access that. You got a 14-day free trial to try it out. Okay, no credit cards or anything, no strings attached. Okay, but now let me move on to the next step. All right, because you now know how to filter for companies, right? How to find those companies. But that still doesn't tell you how you're going to get that 10% rate of return, okay? That's the tricky part. Now, I'm going to give you a formula. And again, this is another one of the things that I want you to take away from this workshop. Because if you understand this, you're going to make much, much better investments, okay? I'm pretty sure of that. I've been using this for many years already, and it works, guys, okay? Here we go. To get your total return, or your total annual return, right? The rate of return, you can get that if you sum the dividend yield of a stock. Okay, for example, to use the example of Coca-Cola, dividend yield is 3.29%, right? And to that, you can add the dividend growth rate. Okay, what percentage like dividend growth has that company been giving you over the last few years? All right, if you sum those two things and you get 10%. You're great, okay? You are very likely going to get that 10% rate of return going forward, okay? Obviously, I'm super simplifying this, all right? There's another element to this equation, and that's the price to earnings differential as well. For the sake of simplicity, I'm not going to cover that in this workshop, all right? But basically, that's it, guys. If you can find a dividend yield and dividend growth rate that's sum to 10 or more, that's an amazing starting point. So let's do that, okay? Let's go to the screener and let's find, so let's go with companies that have been increasing the dividends for 10 years or more. Let's say that we want a dividend yield of 3% or more. And let's also say that the dividend growth rate over the last 10 years, let's set that to 7, okay? And see what happens. So all of a sudden, that's filtered that down to 73 different stocks, all right? I mean, check this out. All these different stocks that you can, do some further analysis on, basically, okay? And, in theory, over the last 10 years, every single one of these companies, if you add their yield and the dividend growth rate, they have mostly given you a 10% rate of return, okay? That doesn't mean that they're not going to do better than 10%, okay? In fact, a lot of these companies tend to do better than that. But this is kind of a great starting point. Now, before we move on to filtering by quality, which is, perhaps the trickier part of this, let me tell you why this formula works, okay? And, this actually, embarrassingly, took me a little too long to actually understand myself. But basically, okay, dividend yield's pretty easy, right? If Coca-Cola pays you a 3% dividend yield, you're going to get 3% in dividends per year. That's pretty self-explanatory, okay? That's 3% to you, done. But why does dividend growth equate to you making money, right? The reason is because, and I'll get a bit deeper into this later when I show you a 3M, a fantastic dividend growth stock. But the reason is that if a company can grow its dividend, let's say 10% a year, or let's say 5% a year, okay? Now, to do that in perpetuity for a very, very long time, or to infinity, basically, the only way it's going to be able to do that and still maintain a relatively okay payout ratio is if the earnings also grow at more or less that rate, okay? So a company cannot just have flat earnings, okay, make the same amount of profit every year and increase its dividend 5% every year. Because eventually it's going to pay more in dividend than it makes in earnings, all right? So the only way for a stock to keep increasing its dividend is for its earnings to also grow more or less at that rate. And guess what happens when the earnings grow? The stock price grows, all right? I mean, there's a ton of studies. I'm not going to get into which ones they are here, basically because I've not prepared the studies. But from my experience, and Warren Buffett often talks about this, there's a direct correlation between a company's ability to make money and therefore grow their earnings per share and the stock price. Okay, so basically, this translates to your total return being however much the stock price grows over time, right, or over a long period of time, and you sum to that the dividend yield, right? If you can get that to 10%, you're doing pretty well, guys. All right, so basically, all 73 of these companies satisfy that metric. All right, I mean, you can, if you don't want 10 years, you can change it to let's say the last 5 years. Okay. We get basically the same companies, right? Basically, needless to say, all of these companies have, performed pretty well, more or less. All right. Now, been talking for 20 minutes straight, guys. Right. Are there any more comments? Hey, Francisco. Okay, looks great so far. Would be great to have some key written notes of the main points at the end, if possible. If you're in my email list, I'm actually going to share quite a lot more stuff over the next few days. So you're going to get that basically. So yeah, basically, if you're watching this and you're watching the replay or you stumble across this video on YouTube, 5 years from now or whatever, just go on to dividendcompass.com, sign up for a free trial, and there's a sequence, there's an email sequence that basically educates you a lot. Okay, it's all completely free. The email sequence. So yeah, guys, keep putting your questions. I'll keep switching back and forth and kind of answering your questions. So basically, let's move on to step number 3, guys, and that is to filter by quality. Like I said, this is perhaps the tougher bit of information. Okay, so this document, okay, the time requirements. I actually offer this with my paid course, by the way. Again, I'm not selling you this course. Freedom with dividends, but I just want to show you that basically this document is what my customers get, right? This is the kind of process that I've manually created over the years that it doesn't necessarily guarantee you'll get great results, but it 99% guarantees it. I think if a company satisfies all of these 9 requirements and you buy it at a decent price, you're going to do really well. Okay, so basically, let me go step by step, all right? So the 9 requirements go as such. Number 1 is that the company needs to have a competitive advantage, right? What do I mean by that, all right? Let me make my face bigger. What do I mean by a competitive advantage? I basically mean that, let's say Coca-Cola or Pepsi, right? Those are great examples of dividend growth stocks, by the way. Those companies have really strong brands, okay? A really strong brand means that, let's say a competitor comes in. let's say it's called like Nuka-Cola or something. If you're into video games, Fallout, obviously, by the way, I've been to video games quite a bit. If you've played the Portal video games, love them. But anyway, let's say Nuka-Cola comes in and creates like a Coca-Cola, spin-off or Coca-Cola competitor, okay? It's going to have a really tough time trying to convince you and me and, the collective, people collectively to switch from Coca-Cola or Pepsi and, drink Nuka-Cola from now on, all right? It's really tough because those brands are so strong. Those companies have spent so much money into getting you to buy their products and getting you to trust the brands, okay? So that's an example of a competitive advantage. There's a lot more, okay? So this is called a qualitative analysis, by the way. It's a really important part, before you buy a stock, that you more or less understand if the company has some advantages, okay, that are going to keep it ahead of the competition. Now, other advantages perhaps is the moat. How big is its economic moat? Have they got a lot of cash in hand? Do they get better deals with their suppliers because of their size, right? Those kinds of things are like, perhaps the first filter. If a company doesn't have any sort of competitive advantage, that's it's not maybe necessarily a red flag, but it's a amber flag, okay? It's an amber warning, okay? So basically, focus on companies that can stay ahead of the competition because of their, unfair advantages, basically, all right? Now, I would consider that actually, having a dividend growth rate of, 5-10 years, that's not an advantage, but a company really can only get to that point if it has some sort of advantage, okay? So, don't take my word for that. Always do your own due diligence. That's like rule number 1 of investing. But, that already is a competitive advantage, okay? Let's go back to the 9 requirements, okay? So basically, let me show my face as well. Oh, here we go. That's the view I like. So basically, guys, that was number 1, okay? Number 2, at least 10 years of dividend growth. Again, it could be 15, it could be 20 maybe if you prefer. But I think 10 years of dividend growth is a really good kind of sweet spot between a company that has proven that it's really, really high quality, that it can withstand, several economic kind of ups and downs, okay, and still be able to be good enough to keep increasing its dividend, not just paying a dividend, but increasing that dividend every year, right? So, basically, let's to go back to the screener, okay? That's what we're filtering by over here. Dividend streak, 10 years or more, okay? Now you could say 50 years, all right? And you'll get 2 results because there's not that many of those. But, 10 years, in my opinion, and again, that's what I teach my students, is a pretty good sweet spot, okay? Requirement number 3 is a dividend yield of 2.5% or more, okay? Why 2.5%? Why not 4? Why not 1? Okay. In my opinion, as an investor, 2.5%, it's not super high, but if it's coupled with some pretty good dividend growth, it's definitely enough kind of current income, all right? Let me give you an example, okay? You could invest in Visa, for example. And Visa is a very, very popular stock at the moment. Everyone loves Visa because it's a super fast growth company. I mean, the last 5 years, let's see, you would have made 162%, on your money, right? Excluding dividends. That's how much your money would have grown. That's some pretty fast growth for 5 years. But check this out, right? The dividend yield it's not even 0.6%. It doesn't even get to 1%. And even though Visa actually increases its dividends pretty quickly, okay, it's still not enough current income. You're not going to get that much money in like right now to be able to get any meaningful passive income right now. Like, sure, you're going to get, perhaps if it continues to be really good, perhaps you get a really high yield on cost, right? In 10, 15, 20 years time, perhaps, but perhaps not, okay? It's kind of like companies like these, I tend to perhaps be a little bit careful because they tend to be more popular, but, I want to be safer, guys. I want that dividend yield to stay, at least 2.5%. Sometimes I've bought companies at 1.9% yield or 2% yield. But for the most part, 2.5, 3%, between 3% and 4%, in my opinion, that's kind of the sweet spot in terms of dividend yield that you start with. Okay, anything more than that, you're going to be a bit careful because it can raise some red flags as we go down these requirements. Okay, so that was number 3. All right, let's put that here. Let's say we want a yield. Okay, 3% was selected. Let's say 2%. Okay, let's just open up the possibilities. Okay, 2% yield at the very least. And we get 120 results. Okay, let's move on, guys. Payout ratio. I love this one. Payout ratio below 70%. Now, if you don't know what the payout ratio is, you really should. Okay, it basically tells you how much money is a company paying out of its profits, out of its earnings, in dividends. Right? Let's say a company makes, I don't know, $5 per share, and you own one share of that company, and it's paying $2.5 for that one share, right? The payout ratio in that situation, it's 2.5 divided by 5. So that's 50%, right? It's paying half of its earnings as a dividend. So basically, needless to say, if a company gets to anywhere close to being 100% or more, that's a massive red flag, okay? Because that means that the company is not making enough money to even be able to cover its dividend, let alone, reinvesting back in the business, let alone anything else, okay? So yeah, basically, guys, payout ratio below 70% is like my limit. I normally look for, even lower than that. Somewhere around 50, 60% is a good kind of sweet spot. But, you got to look at the payout ratio, and you got to look at actually, guys, I'm going to show you an example as I go through this because you're going to learn a lot better. So let me see if there's any more questions, guys. Leave your questions in the chat, by the way, if you've just joined the live stream. And I'll keep going back to the chat to answer them, okay? So let me give you an example, all right? Here we go. This is 3M Corporation, okay? It's a dividend king with 62 years of dividend growth streak, right? It's actually been increasing its dividends since 1958, right? It's mind-blowing. And yeah, basically this is, when you click on any of these, it's going to give you to its own kind of page that, like at the rough level, it's going to give you this. I call this the rough snapshot, okay? You get the company, the sector, the industry. You hover over this, it actually tells you what the company does, all right? And basically the last 6 months of price, and also the live price, okay? This is the live price at the moment. You see this little green blob, that means the market is open. But let me basically go back to the 9 requirements. And let's go one by one using 3M as an example, okay? So a competitive advantage, right? Now, 3M basically, I did this analysis a while ago. I honestly cannot remember this, but 3M is, I seem to believe that it's a very well diversified industrials company. They do everything from Post-it notes to, let me see, 3M Corp, right? Let's have a quick look, because in fact, 3M brands, because they do so many things that you probably didn't even realize. There you go, Post-it notes, Scotch Brit, I don't know how you pronounce that. Next Scare, okay, they've got so many brands. Okay, they do automotive parts. They make stuff that goes into energy, stuff that goes into safety. They make like safety goggles, all right? They made masks, okay? During this pandemic, 3M were like one of the main suppliers, I'm pretty sure they still are, of what are they called? Surgery masks, right? So yeah, guys, this is a competitive advantage that 3M has, okay? They make all these things that are in all sorts of different industries, okay? And what happens is that, let's say one industry is doing really badly. It doesn't matter that much to 3M because, they're really well diversified. And, they're basically an amazing company. Again, I can't remember off the top of my head the qualitative analysis that I did on 3M, but basically it does have a competitive advantage. And basically the fact that they've been increasing the dividend every single year, every single year without fail for 62 years, that basically tells you that they know what they're doing. They have to have a strong management to get to that point. There's only, I believe, 28 companies, I think, or 29 companies in the American market that have a dividend growth streak of at least 50 years, So that just shows you how select that group is. And 3M is one of the best ones. 3M is one of the ones that has the longest streak, all right? So basically, it's got a competitive advantage, yes. It's got at least 10 years of dividend growth, yes. A dividend yield of 2.5%. So I keep going to low, so I'll show you this later. But at the moment, the yield is 3.5%, which as someone who had 3M on my personal watch list for like 3 or 4 years, it's only recently got to that yield. In fact, let me show you. I'm going to cover this in a minute, but let me show you the dividend yield, right? This is the dividend yield of 3M over the last few years. And basically, it got pretty low, in the 2%, less than 3% for quite a few years. And it's only really since last year that it's got above 3%. So at the moment, you can see, right, at the moment, the yield is 2.5%, and the average yield over the last 5 years has been 3.09%, right? So you're getting a slightly better yield than you normally get with 3M, basically. So yeah, it obviously satisfies the yield as well. Payout ratio. What is 3M's payout ratio? Well, at the moment, it's 67.5%, It's getting close to that 70% payout ratio. But as I'm going to cover in a second, that's only because the company's been struggling a little bit at the moment, It's going through some tough times, but in my opinion, they're going to do really well over the long term. It's just, temporary lower earnings per share, which means that the payout ratio goes higher, But it's still not above 70%, which is good, That's why this is yellow. It's yellow because, it's okay. It's not great, It's not like this, bright green. Bright green means it's amazing, but it's still okay. It's definitely passable, all right? Let's move on to the recent dividend increases, all right? Basically, what's the average dividend growth rate over the last few years? Now, it could be the last 5 years, it could be the last 10 years, it could be the last 3 years, I like to look at 10 years, So, for example, for 3M, this here basically, at a very quick glance, tells you the 10-year average dividend growth rate, right? Which has been pretty much 11% per year dividend growth over the last 10 years, all right? Now, that gives you already a pretty good indication that this is not just an okay company, all right? But let me show you a bit more detail, all right? If we keep scrolling down, you can see dividends, all right? And over here, you're going to get a lot of dividend information from when the company pays dividends, and which months it pays dividends. If a new dividend has been announced, you'll see it here. Let me show you. There you go. So in the case of 3M, a new dividend has not yet been announced, But this is an example of a company that has an next dividend that's been announced, It tells you how much you're going to get paid, per share, when the dividend X date is, and when the payment date is, all right? But anyway, let's go back to 3M, This is 3M. Here we go, right? Over here, you can see the last 20 years of dividend data, all right? Let me just turn the earnings off for a second. From the year 2000 to the year 2019, all right? Because that's the last year that we have full data for, right? So basically, the dividend grew in the last 20 years by 8.5% per year, which is fantastic, but it actually accelerated. So in the last 5 to 10 years, it's kind of hovered at around 10%. In the last 3 years, it's definitely slowed down a little bit, In 2017, it only went up by 5.9%, 2018, 15%, and 2019, less than 6%. And in fact, the latest dividend increase was pretty low, I think it was something like 2%. Like I said, it's an industrial company. It's kind of cyclical, But anyway, guys, this gives you a very quick idea for any company that you're analyzing, to see the recent dividend growth rate. Okay, so if we go back to the screener here inside Dividend Compass, let's close yield, and I say close, it's only minimized, right? So let's say that we're interested in a dividend growth rate of over 7%. Okay, because remember, let's go back to the notes. Okay, dividend yield plus dividend growth, like more or less, it's going to give you your total return per year. Okay, so that's why we're looking for stocks with a dividend yield of more or less 3%, and which means that we're looking for a dividend growth rate of 7% or more. All right, so let's go back to the screener. Okay, and yeah, we put dividend growth rate over the last 10 years of 7%. And let's say, in fact, let's get rid of 5 years. Okay, let's make this a little bit better, right? So basically, these 125 companies have both a dividend yield of over 3%. Actually, no, 2%. Let's put this to 3%. Okay, that's a little bit better. 72 companies have a dividend yield, a current dividend yield of 3% or more, but also have a dividend growth rate on average of over 7%. All right. So basically, if you do those two things, okay, you're already down to requirement number 5. All right. By the way, guys, if you just joined the stream at this point, I'm basically showing you my process to find fantastic dividend growth stocks. Okay. So we're now to point number 5. Okay, the requirements that I like to look for, and that I think you really should use as well, in order to get really good stocks, basically. So requirement number 6 is return on equity. Okay, now let's actually go back to 3M. Okay, we're back to 3M, and over here we can actually see the ROE. Okay, the return on equity. That's basically how efficient the company is with its money. Okay, it's how much return they get from all the equity. Okay, all the money that the company has. How well can this company kind of invest that money from shareholders to make more money? Okay, that's the whole point of a business. All right, guys, to make money. So basically, a company with a good return on equity, it's a sign of an efficient company. And 3M is through the roof. Okay, almost 50% return on equity. This is not that normal. Okay, in fact, let's go back to the screener. Here we go. Let's go to return on equity, and let's put 10% or more. All right. Now check this out, guys. We've gone from like 70 stocks or 50 stocks to like 18 only. Okay. That's because this is quite difficult to do, right? And we want to be a little bit more lenient. We can put like an ROE over 5%, right? But 10% is normally my recommendation. Let's keep going. So another important, 7 and 8, right? Requirements 7 and 8 are to do with debt. Now, a company's debt is basically, there's a very famous quote by a very famous investor. I can't remember his name now. Seth Klarman, I think his name is. He basically has a really good quote on one of his books that says, the number one reason that companies go bankrupt is too much leverage. Okay, and too much leverage means that they have too much debt. And if a company has too much debt and it cannot pay that debt back, that's like a surefire way to become bankrupt and basically make you lose a lot of money. Okay, so that's why I often really want to see, first of all, a debt to equity ratio below 1, but also an interest coverage ratio above 4. It says 4 here, but lately I actually a bit more stringent. I want an 8%. Sorry, not 8%. I want an interest coverage ratio above 8. All right. Let me show you what I mean. So if we go back to 3M again, all these requirements, by the way, the reason I coded Dividend Compass to look like this is because I want to see at a glance that all these requirements are satisfied. Okay, because if we scroll down, there's a lot more data on every company. Okay, but for now, I want to get all of my bases covered. All right, so debt to equity ratio. All right, this is where 3M doesn't pass this requirement. Okay, its debt to equity ratio is above 1. Okay, that's why it's in red, and it means it's bad. Okay, it's not good. But when you look at debt, you're gonna look at both sides of the equation. Okay, you're gonna look at debt to equity ratio, but also the interest coverage. Okay, the interest coverage basically means how many times over can they cover their debt with the money that they make. Okay, with their operating cash flow, I think, or is it earnings? I can't remember at the moment. But basically, an interest coverage above 8, in my opinion, is good, but they should definitely be able to cover their interest many, many times over. Okay, the more the better, right? So while for 3M, it's got a pretty high debt to equity ratio, which is definitely an amber flag in my opinion. The other side of the coin is that the interest coverage ratio is almost 12. Okay, which is good. So one last time, I believe. Let's go back to the screener. Let's put debt to equity ratio less than 1. Wow. You see, it's very difficult that right now companies have a debt to equity ratio of less than 1 because of everything that's happening. Companies are having to take on more debt. Okay, so let's just put 1.5 just to be safer, and let's also put let's leave this for now. Okay, this is already quite a stringent filter. Okay, pretty much all these companies are going to satisfy. No, actually, they're not. The payout ratio, about 70. Okay, if with that stringent, only one company passes all my requirements at the moment. Okay, that's still dynamics. All right, that's why the 9 requirements. All right. And again, I've not covered number 9, but I'll get that in a second. These are a great starting point, but sometimes you're going to have to be a little bit more lenient, perhaps, if you really want to, find opportunities, right? In the case of 3M, it wouldn't actually pass the 9 requirements because of its debt, but it passes everything else. Okay, and even the PE ratio, while it's not, super cheap, it's not too bad. Okay, so basically, that is how you filter, all these amazing companies, guys. That's how you get to the point where you can then do some further analysis. All right. So, requirement number 9. I want to see growth in earnings. Okay. If the earnings are not growing, that's really bad for the dividend. It's really bad for the stock price. Okay. So there has to be some sort of earnings growth, and the company has to be poised to keep growing those earnings over time. Okay, that's possibly the most important requirement. Excuse me, it's probably the most important requirement out of all of them, really. So basically, to check that again, when you go here, this is the EPS growth rate. All right, you can see that it has grown over the last few years. Not super fast. Okay, less than 5%. It's not amazing, but there has been some growth. Okay, and again, like I said earlier in the stream, I think 3M is going to do really well over a long period of time. Okay, so basically, now that I've shown you this, let's have a look at. Let's go a bit deeper into. Okay, so we've already filtered by quality. Okay, that was step number 3, and let's have a look at. Okay, so out of all of these things, right, the 2 things that stand out to me as perhaps not being ideal are the payout ratio and the debt to equity ratio. Okay, that's why if you actually scroll all the way to the bottom, you get here to the fundamentals. Okay, here's all the financials, all the fundamentals, and their history over the last 10 years. And this is where you can dig a little bit deeper. Okay, so for example, the payout ratio. At the moment, we said that it's actually almost 70%. Okay, that's the latest payout ratio. But we can actually see that it's been rising up over the last few years. From 2010, until 2013, 2014, it was less than 50%. Okay, that's a really nice payout ratio. And in fact, the average payout ratio is 45%. Right? That's why again, Dividend Compass just makes all this so easy. Because like at a really quick glance, you can see a green tick if it's good, and a red cross if it's not. Okay, so that's why. Here we go, right? The debt to equity ratio is too high, right? And here's where this would prompt more research, okay? Because 3M were pretty good. The debt to equity ratio was below 1, but from 2014 onwards, it's been increasing every year to the point where it's the highest it's been in the last 10 years right now. Okay, so obviously something's going on there. That's why use this to prompt you to say, okay, what happened? Okay, let me perhaps read the latest annual report from 3M. Okay, let's head to their investors website and let's see basically why this is. All right, and let me use that to help me make a better decision. Okay, but basically, the interest coverage, it's definitely getting lower. Okay, that's why its debt levels are getting a little bit. It's not the right direction to go. Okay, the interest coverage has also gone down, but it's still okay. Its revenue has increased quite significantly. Okay, over the last 10 years. Operating margin is good. Okay, it makes some solid margins. Okay, and again that comes from competitive advantages amongst many things. Anyway, I'm not going to go super into detail, but I just want to show you, real quick that the amount of data you can have at your fingertips, basically, with Dividend Compass. All right. And by the way, guys, if I've not mentioned this before, there's a link to get a free 14-day trial. Okay, completely free, no credit card required. It's in the comments. It's in the description of this live stream. Okay, so just head over there. It's going to take you to here. Okay, the homepage of Dividend Compass, and basically you can create an account. It's completely free for 14 days, and you can actually see if it's for you at all. Okay, we've only scratched the surface, by the way. There's so many more bits that. Let me check the time. Wow, 51 minutes. I need to hurry this up, guys. It's been almost an hour. I'm out of focus now. Here we go. So we are now to step number 3. We've already covered that. Hopefully you've learned an awful lot already. Now let's talk about the fair price, okay? Because 3M, it might satisfy all the requirements. You might think it's really good, but you might look at the earnings per share over time. Okay, you might see that the payout ratio, it's pretty good over time. Okay, you might be convinced, all right, but at what price do you buy 3M, right? And at the moment, by the way, it's almost at $170. So this is where the valuation section comes in. All right, now I've programmed 4 different valuation techniques into Dividend Compass, right? The yield method, the PE method, the dividend discount model, and also seeing what analysts are recommending. All right, Wall Street analysts. So let's go one by one, okay? Because none of these should basically tell you what price they are, but they should kind of give you a rough estimate of what price perhaps would be a fair price to buy any one stock. All right. So first of all, I like to look at where the average dividend yield of any stock is over the last few years compared to its current dividend yield, right? Because over time, there are certain companies that will have a certain dividend yield. And over time, it always tends to go back to that dividend yield, okay? That's why if you can actually work out the deviation from that dividend yield, you can actually work out a fair price. And this is where, Dividend Compass makes it so easy for you. In this case, it tells you potentially undervalued. It says the current yield of 3.5% is 13.3% higher, which is good, than its 5-year yield of 3.09%. And it automatically works out that the fair price should be somewhere around $191. Okay. Now, again, this you can hover here for more information. I don't let this calculation go too crazy because you can get some pretty crazy numbers. So I tend to limit it somewhere around 20% discount here. So this says $191, all right? So basically, that is the fair price using this method. Now let's move on to the PE method, all right? The price to earnings method. Same principle, okay? These companies tend to hover over, the same PE ratio as well. So in this case, it's only telling you, hey, it looks like it's potentially fairly valued. Okay, 3M is not super undervalued. It's not super overvalued. It's gonna at a good PE ratio. Okay, and if you click on this, by the way, and same with the yield. You can see the history, okay? You can see how this has progressed over the last few years. It's very easy to compare where it's at, right? So, this tells me, okay, the P ratio, you're not getting a bargain for 3M right now, but you are getting slightly more dividend yield that you would normally get, okay? That's why, the price here is 191 and 161, right? The next step is to look at what analysts are saying, okay? So analysts on Wall Street reckon that a fair price, the price they recommend on average to buy 3M is 170, okay? So it's kind of like, it's pretty much the price that it's at now, basically, and not too far from this one, a little bit far from this one, okay? So already we're getting an idea. But what I've done here is, use my favorite method of analyzing a fair price that's out there, okay? This is called a dividend discount model. And over here, if you hover, it tells you some explanation, some rough explanation of what it means, right? But basically, you give it the expected dividend growth rate, okay, for forever, basically, and what discount rate or what rate of return you're after, okay? So let's say I'm after 10% discount, and let's say that here's where you have to kind of predict, what dividend growth rate it's going to have over time, right? That's where, history is pretty good, all right? We see here that over the last 20 years, the dividend growth rate has been 8.5%, okay? And, the earnings have also kind of grown roughly at around that same rate over the last 20 years, okay? That's why the payout ratio is going to hover at around 50% over that time. But you always want to be a bit safer, okay? That's why I normally like to input some sort of margin of safety. So instead of 8%, let's say 7%, right? Put that there. You calculate, okay, and it tells you, hey, according to this calculation, the fair price for 3M is actually $210 per share, okay? So that's actually the highest one out of all of them, okay? So basically, this means that if this company was able to keep increasing its dividend, like from now to pretty much infinity, or for the foreseeable future, by 7%, you will get that 10% rate of return that you are after, okay? But the cool thing about this is that, you can actually go a little bit safer, okay? Let's say 6.5%, all right? At 6.5%, if we can do that over the long run, the fair price goes down to $180, right? So here we go, right? That's basically pretty much in line with all these other calculations. The average is probably around 170, right? And here comes the cool part about Dividend Compass, right? I get to 170, I click here, and I want to add 3M to my watch list, okay? I click on that, it thinks for a second, and it's going to add 3M to my watch list, right? And it's actually going to notify me by email whenever 3M reaches the price that I've set for it, okay? So that's pretty cool, I think. What else, guys? Let me quickly check if there's been any new comments. Okay, so I'm getting a comment by Francisco. Hey man, thanks for chilling out. I think we're going to bed. So I'm curious, where do you get the data for the stocks on Dividend Compass? Is it reliable and updated? Yes, it is reliable. I use an API. Actually, I use two APIs, right? One is called IEX, which gives me all the price values and some fundamentals, and that is updated basically live. Okay, so all this. So for example, this live price, this is literally the live price at the moment, right? Because this is updated live. As for the fundamentals, they're from a different API called EOD historical data. And from the research that I did on data providers, they're great bang for buck. Okay, so they're still expensive, but they give you so much data. They give you 20 years of data. So I would say this data is like 99% reliable, basically. Even like Bloomberg, for example, sometimes they make mistakes, and that costs like thousands every month for that data. Okay, so this should always be taken as a starting point. You should always I always verify this, okay, to make sure that everything is okay. Okay, but it's definitely more reliable in my opinion than this, for example, which is still great. If you've just joined the stream, by the way, this is a great starting point. This is called the US Dividend Champions spreadsheet. Okay, this is not mine, by the way. This is basically what a lot of dividend growth investors use. But Dividend Compass, in my opinion, is way better than that. You get way more reliable data that way. Okay, so right, we're about to finish. The last step, guys. Last step. Finally, I've been talking for like an hour. The last step is to track effectively. All right. So you've done all that work. All right. You've made sure that the company satisfies all your metrics. You've made sure that it's got a really long streak of dividend growth in general. Okay. You've worked out a fair value, and you've seen that the fundamentals are pretty good. Okay. And then you've read their annual reports. You've read what the CEO. Excuse me. My throat, man. You've seen what the 3O is saying that, predicting is going to happen, from now to all the next 5 years. Okay. What do you do then? Okay. How do you track all this? Well, this is basically, one of the pretty much my favorite tool inside Dividend Compass, right? And that is the portfolio tracker. Okay. This is just a play portfolio. Obviously, my name is not Walt, as you know. Basically, all you have to do is just put in your investments. All right. You can upload an Excel file with all your transactions, and it will input that. It will tell you the live price, the live dividend, the live payout ratio of all of these stocks. Okay, because it's not just okay to buy a stock and then forget about it. Okay, it's definitely what you should do, but I recommend perhaps once a year or maybe 6 months to go back and to check. Okay, let's see what's happening. Okay, after the increase of dividend, is the payout ratio still good? Why did I buy this stock? Right, and this is where Dividend Compass makes it really easy for you. Basically, you can filter by difference, by payout ratio, by the amount of income that particular position will give you. Okay, it's pretty cool. Over here, you can see the price of the portfolio. Okay, at the moment, what this does is it tells you, okay, this particular portfolio, how would it have performed, over the last 10 years, right? So from 2010 to now, this is what the price would have done. Okay, so in this case, pretty well. You can very quickly see how much you're gaining, the beta of your portfolio, how well diversified you are by sector. Okay, how much money is in each of the different sectors. Also, how much in dividends you're going to be paid in the next year, every month on average, which months you're actually going to be paid those dividends, right? And your average yield on cost. Basically, a lot of information. But that's not everything, okay? If you scroll down here, right, this is basically the reason why I programmed the Dividend Compass, right? Because this doesn't really exist out there unless you've got a really complex spreadsheet and somehow you have integrated it with a really powerful API. This on the fly, okay, literally this takes a few seconds only. This is going to tell you the specific dividend growth rate of your portfolio, okay, of your current portfolio. It's going to tell you, right, so your current portfolio right now, okay, it pays, so in this case, right, $1,500 per year, right? So that's here, a 2020 estimate, right, $1,500. But it actually tells you, so in 2019, you would have earned $1,400. In 2018, $1,200, all the way back to 2010, where you would have only earned $600 in dividends. This shows you the real power of dividend growth, guys. Okay, so if you have this portfolio, this exact portfolio, or whatever you put in there, this will show you how it's done in terms of dividends, right? You can see here that the colored numbers are the dividend growth every year, and you can see that in this case it's pretty good. But it also shows you, so you can actually turn it off. It also shows you the earnings per share. Again, the proportional earnings of that portfolio, all right? And it shows you the payout ratio of your portfolio, which is something that, this is why I spent the last 7 months coding this, right? Because I wanted to know this for my own 6-figure portfolio, all right? And now I want people to try it. I want you to try it, okay? So, this shows you your payout ratio, your earnings per share, and it even tells you the estimated earnings per share and dividends, right? Obviously, needless to say, 2020 is not looking like a great year. That's hence the massive decrease here, okay? But it goes even deeper, okay? I'm not going to go super into detail, but here you can actually tell it what dividend growth rate you expect your investments to do, and it will tell you what your portfolio is going to do over the next few decades, right? So some really cool things to look at. This is some more details into the price of your portfolio, and some more details into the specific sector diversification that you have, how much money is coming from each sector, okay? I'm going to add a lot more data here, by the way, okay? So, if you get your trial of Dividend Compass, submit your feedback here, okay? Over here you see feedback. Let me know of any features that you'd like to see, basically, okay? So that's how you track your portfolio, basically, guys. You either do, create an Excel, or you find some sort of like free dividend tracker. I'll be honest, they do exist, but they're not as good as this. They're nowhere near as good as this. And that's the only reason that I created this, okay? And the last thing that I wanted to show you is the dividend calendar, all right? Now, this is the really cool part. What the dividend calendar does is it gets your portfolio, all right? All your entire portfolio, okay? You can see here the $1,500 per year, all right, that you should receive in dividends over the next 12 months. It puts all of that into a dividend calendar, right? So you can actually see how much a company, how much a stock is going to pay you, and when, okay? Very, very, very easily, very, very cool. Okay, so in this example, it will tell you, okay, so for October 2020, you should receive $66 from 4 different stocks. Then it compares it to last October, and it tells you that your dividends actually increased by 3%, right? You can actually go back 1 month, you can go back 1 year, you can go back many years, okay? This is gonna show you exactly your dividend growth history, okay? You can go back to the current month. And what's really cool as well is that it tells you when the next dividend is going to hit your bank account, okay? So in my case, well, again, not my case, this is not my portfolio. Federal Realty Trust should pay this person $21 on the 15th of October. So that's tomorrow, right? And 1 day later, Medtronic is going to pay $23, right? I use this with my own portfolio that I'm going to reveal once I get to 2,000 subscribers on YouTube, okay? So, make sure you share my channel to people. Make sure you subscribe. Make sure you like all my videos, because as soon as I get to 2,000 subscribers, I'm going to show my multiple 6-figure portfolio and, how much I earn every month. I'm going to show you this, okay? The dividend calendar. I'm going to show you my portfolio and every single stock in it, and how it's performed, how many dividends have they paid me, the kinds of companies that I own. All right. So that is basically, let's see, let me see anything. Oh yeah, I was going to show you some companies that definitely pass most of those requirements, and I personally own and I really, really love. Okay, so obviously 3M is one of them. I really recommend, again, not a financial advisor, but I recommend those companies. I actually created a really in-depth video about this on my YouTube channel. So, go to my videos. It's one of the last videos that I posted. It's like a 20-minute video. It's a really good company, okay? Its yield is not very high, but what's spectacular about this company is its dividend growth, okay? Dividend growth rate over the last 20 years has been 23.5% per year on average. That's mind-blowing, guys, all right? And you can see here how crazy that is, all right? There's some years where, they've increased the dividends by like 60% plus, right? And, their earnings per share is doing really well as well, I mean, the payout ratio normally hovers at around 30-something%, all right? Sometimes even lower. So, definitely very high debt at the moment, pretty high PE ratio, forward PE ratio. So definitely some food for thought here, but fantastic company. And then finally, Prudential Financial. This is an insurance company. Again, I've mentioned it in one of my last videos, and it's got a really high dividend yield, 6.6% if you buy it, sort of now. Good payout ratio, it's got a decent dividend streak. All right, in 2008, they had to cut their dividend. They cut the dividend in 2008 for obvious reasons. But ever since then, they've been increasing at a very high rate, and their earnings per share definitely a bit up and down, but really good, really nice growth over the last 10 years. Pretty good payout ratio as well. Actually, very good payout ratio, like 34%, right, in 2019, and lately 44%. Still very healthy. Okay, so yeah. Don't look too closely, by the way, on the score here. Okay, this is still a beta function of Dividend Compass. Okay, I still need to refine the algorithm, but this is basically going to give you an idea of everything that I've covered, all the requirements, everything into one number, basically. Okay, so it's going to be pretty cool, I think. What else? Okay, so I've told you, right? Prudential Financial, those companies, 3M, Snap-on as well. Snap-on, actually, I don't personally own this. Okay, I've not done my due diligence on this company, but it does satisfy pretty much all my requirements. Okay, you can see all the greens and yellows here. Right, it's got an okay yield, good dividend growth, not super quick, but basically good all round, really. Again, I'm not sure about the competitive advantages, but let's have a look. Let's see the earnings, special dividends in case there are some. I really like to see this. Okay, I really like to see this when the earnings per share seems to outpace the dividend increases. That's a really good sign. Okay, so I'm definitely gonna do a bit more research on Snap-on. Let me know in the comments if you're interested in this, by the way. But something else that I want you to notice is that, look, okay, it didn't cut its dividend. It actually only froze it. Okay, so look at this, right? 2003, it paid the same dividend for 3 years, and then it carried on increasing it. 2009, it froze it for 1 year, but it didn't cut it. Okay, so that, again, while its dividend growth streak is only 10 years, it's not cut its dividends in at least 20 years. Right, so again, that's definitely a good sign of Snap-on. Okay, right, guys. Here we go. Questions. Been talking for like an hour and 12 minutes. Okay, so guys, here's the Q&A section. Let's see. I'm gonna change my face now. Okay, Magdalena, I can't find the site. Would you please send the link? The link should be just dividendcompass.com. I think it should be in the description of this video. Unless you're talking about the dripinvesting.org website. That's like the okay starting point, but not as good kind of data as Dividend Compass, right? Okay, Clownin around says, "What's up, man?" It's been a while. You're always commenting on videos. I really appreciate the support. I've not really posted many videos recently because I've just been really sprinting to finish Dividend Compass. It's finally at this point. So from now on, at least one video a week on my YouTube channel. Okay, so I'm gonna get back into making videos. So Francisco says, "Thank you for the presentation, Ricard. I've accessed Dividend Compass and we'll try to make the most of the trial." Awesome, dude. That's great news. Yeah, honestly, give me as much feedback as you can because there are other tools in the market. Of course, I've done my competitor analysis, but I really want to make this the best tool for dividend growth investors. Okay, so I kind of started with myself as a starting point, but here's where I want as much feedback from people as possible because I want to make the tool that people actually want. Okay, so whether it's really detailed metrics on stocks or basically anything about the portfolio, like what stock pays the most dividends or anything, right? So this is kind of where I want people's inputs, right? So yeah, guys, this is basically the end of the stream. If you are on my email list, right, I just want to give a little sales pitch here, very quick. For the next 14 days, okay, for the next 2 weeks, so from now until the 28th of October, if you enroll in Dividend Compass and you actually start paying monthly, you get Freedom with Dividends, my dividend investing course, for free. Okay, and let me just show you real quick. This is not just a random course. Okay, this is a full-on course that many people have been going through. Let me scroll at the bottom, and this costs $200 basically. So if you're interested in really learning what I've taught you now, but in a lot more detail, and using Dividend Compass on the side, yeah, basically you get Freedom with Dividends completely for free, the tree version, okay, the full version, over the next 14 days, if you're interested in Dividend Compass at all. Okay, that's like a little special offer that I want to give you guys as a little thank you for watching this or watching this in the future. Yeah, if you're in my email list, you're gonna get more emails about this. Okay, so don't worry, I'm not gonna be annoying after a while, but hopefully you bear with me. But yeah, guys, that is it. Hopefully I've answered all your questions. Email me any questions at all, and I will get back to you, as soon as I can. Take Dividend Compass for a spin. Okay, I put a ton of blood, sweat, and tears into this, basically, and yeah, I've already had some beta testers go through it. They've been loving it so far, so I'm really curious to hear what you guys think, and whether it helps you to really quickly and easily analyze stocks and then track them. All right. So yeah, guys, I'm gonna be making this as a video on my YouTube channel. So if you've just joined late or whatever, you can just go back and watch it. Okay. Hopefully, I mean, it's my first stream. Maybe maybe this doesn't actually work and it doesn't save the stream. Hopefully it will. All right. So yeah, guys, if there's no more questions, I will go and have some dinner because it's like 8:15 here in Spain. And yeah, guys, thank you so much for those of you that were here, clowning around, Francisco, Magdalena, Lahib. Yeah, guys, thank you so much for hanging out with me on this beautiful Wednesday afternoon, evening, night, depending on where you are. So yeah, guys, take it easy. I'll see you in the next video. All right, guys, thank you. Bye-bye.